Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 11th edition of Market Outlook. So yet again, we're waiting on Greece, the European Union, to make a decision on Grexit or not. Uh, Huge reversal in strategy and tactics by the Greek government. Their bluff was called. They lost. Not a pretty picture, but nonetheless, it sort of has opened up the door towards some more negotiations, which are ongoing as I'm doing this video. Don't forget to sign up for this and get it free every week by going to www.marketgauge.com. Okay, let's get into the markets right away. As you can see, what we're doing right here, you've got an interesting picture because we're holding right at the bottom of the trading channel and the 200-day moving average. We actually closed above the 200 for the first time in about 3 days on Friday. So positive sign, but again, very news-driven market. The best tactics for trading this type of environment is mostly on large gaps, to watch them either fade very large gaps or wait for OR reversals in the direction of the gap, and that is a very short-term trading strategy. But overall, as you can see, the up days did not have increasing volume, with the exception of earlier in the week. So overall, very mixed picture. A lot of capital inflow, some strong buying this week as the market dropped. But again, you want to look at this whole pattern over the last week and a half and basically know that the trend is going to shift with a move under that 204 level, and that would be to the downside because we would be confirming the low breakdown and closing under the 200-day moving average again. That would not be a positive sign for the market. On the other hand, potential test of the 50 to potentially new highs can be set up if we take out and breach the meat of all of this action here, which is above that 208.50 level. So you got a nice 2% range with this volatility of what I would consider noise. Now, since we closed in the upper end of the range, it'll be interesting to see just how this market gaps on Monday. So again, that short-term tactic should suit the market well for high volatility in a wide range against this key moving average, which is the 200-day. Now, overall, let's take a look at the weekly chart in the spiders, because we like to look at the 65-week moving average as sort of the intermediate term trend indicator on the weekly time frame. So that's pretty good long-term indication. As you can see, that is still intact. Same thing on our key monthly moving average. That's well intact as well. So short term, still a little iffy depending on how the market resolves itself around that 200-day moving average, while the longer term trends are still intact. Looking at sentiment, different picture here. On a weekly basis, we've closed right on that 65-week moving average. How it resolves here is probably going to be just a reflection of what happens in the overall market. But clearly, if we close above that blue line, it's going to indicate that the sentiment has shifted, volatility is picking up, and the market is under pressure. Conversely, a move under the 50-day moving average would also coincide with a move under that 65-week. It just happens to coincide, and that would mean that the markets have digested all this bad news and is on the way up. But as you can see, markets are sitting and trying to make a decision. Is the trend, the core trend, going to continue, or are we going into corrective mode? At this point, long-term and intermediate-term trends are still intact. Looking at sentiment, looking at the volatility earlier this week, this is let me move this chart here and look at the daily chart. As you can see, we got to pretty oversold conditions twice in the last week and a half, and the market's bounced. You got some good 300-point moves. So right now, it looks like we're getting a couple tests here of pretty extreme bearishness, and we're starting to work off of it. So I would say sentiment is leading more towards a positive on this particular view of it, looking at 1 month to 3 month volatility. The sentiment is clearly been wrung out, got a lot of bearish sentiment, starting to reverse. Twice now you've had bounces off of what we call pretty low numbers, not massive extremes. So obviously, if something unravels again in Greece and they do exit, you could expect another attack down here as well. Looking at some market internals a bit more positive. On that 300, the first thrust down, we got extremely oversold. Since then, we've been on a buy signal, and it's still working itself out. So the market internals looking a bit more positive and has really wrung itself out on that pretty steep drop and a very quick one that occurred on the news on the prior week. Taking a look at TLTs, taking a look at bonds, you know that we've been pretty negative on the outlook for bond prices, looking that rates are going to increase. We are trading at the bottom of the recent trading range. Not that far off. It looked like for a moment there with the market selling off that there was a flight to quality, caused a pretty sharp rally. But again, by the end of the week, with Yellen saying that she wants to move on rates probably sooner rather than later, definitely put some pressure on, and all that money moving into U.S. Treasuries sort of reversed. So again, overall market looking under pressure here still. Taking a look at the weekly charts, same scenario. It's very possible that we're getting a change in trend. Look at this. The 200-week moving average, which has been intact for a year and 3/4 or so, under attack. This is now the third week in a row that we have closed under the 200-week moving average. And interesting, we touched with the rally last week, we touched the top of the of this trading band in here, which includes the longer term moving average. The shorter term moving average, which is the 65-week, and rejected it handily. So again, green line here, 200-week, that's your super long term on the weekly. Your intermediate term, or the 65-week moving average, we're now basically what we would call in a distribution phase. So not looking really good here on the rates. Lots of pressure. So that is something to keep in mind. Temporarily, at least, could also continue to put some upward or downward pressure on the S&P and the general equities market. So that is something to keep an eye out on as well. Now, let's take a look at silver, because silver has got a very interesting chart pattern. Let's go to the daily chart. And as you can see on the daily chart, looking at silver, you have what is considered a classic island bottom, right? And this one is really interesting because you had this huge flush, right? We took out basically one, two, three, 10 months of price action, right? The low was set back here in November of last year. We're already into July. So we tested that low again back in the mid part of March, or the later part of March of this year. And we tested and took it out, cleaned out all the stops. Look at this classic pattern here. Huge volume, cleaned out everything. Massive blow off volume, right? Huge gap was left. And look what happened. After this huge clean out of all the longs, you basically left an island bottom after that key reversal type day, inside an inside day, then a gap up, and a decent close on Friday. So this is sort of a classic chart pattern, and it's got a lot of ingredients in terms of a textbook study, because not only is this island bottom interesting in terms of the fact that it's got that inside day set up there as well, but it also really, this is a critical multi-year low with massive volume, right? It's got one of the highest volume days going back, well, since the beginning of this chart. So, it's several years back here. So the fact that you had massive volume, absolute clean out on new lows, multi-year lows, and no follow through is an interesting sign. So clearly there's a couple ways to tactically play this. Wouldn't really want to see any any new lows below 14, but it does look like most of the damage potentially already done. So interesting pattern to watch. Let's take a look at gold and see what there's anything there as well. Not quite as interesting. Gold basically holding and potentially setting up a triple bottom. Didn't act nearly as weak as the silver market, as that's a bit more of a industrial, well, quite a bit more. Silver is probably 50 to 60% industrial demand, as opposed to alternative currency like gold is a better reflection of. So as people theoretically look for times of stress as an alternative investment, potential currency. It really hasn't materialized with the Greek crisis. And on the other hand, we did hold the lows, but one thing that the silver market did as it cleaned out and created that island bottom, it cleaned out certainly all the stops. So you still have a lot of stops intact here in gold. So that'll be interesting to see the juxtaposition of the two. But again, going back to the silver market, that's a really classic, interesting pattern. And again, if we look at the weekly chart, you can see we basically closed above those recent intra-week lows going back to 2014, but we definitely closed above the absolute lows. So that in itself is also a positive sign. And in terms of the fundamentals here, China may have a lot to do with some of this industrial demand for certain metals. So watching how it plays out against China, and if that market stabilizes, will probably have a big impact on whether this pattern actually works out. and you've just seen the absolute blow off bottom in silver. All right, that's it for now. We'll see what happens with the Greek crisis. Look forward to seeing you next week, and take care.